Okay, the second section of Part 3, Valuing and Reporting Investments. There are three ways of categorizing debt and stock investments, and their categories are trading securities, available for sale securities, and held to maturity securities. Now, please note this applies, we use the term securities, but it means debt and stock investments. So this is addressing both purchases of debt and purchases of stock, in which holdings are less than 20%. We're still dealing only with that 20% or less than 20%, I should say. Let's start with trading securities. Now, this is that big departure, big departure from the cost method. Companies holding trading securities have the intent to sell them in a short period, very short, sometimes as frequently as day by day. There are going to be frequent buying and selling of trading securities. Companies report trading securities at fair value. Let's just say that again. Companies report trading securities at fair value. They report changes from cost as part of net income. This is called mark to market because it adjusts the value of the trading security to the market price. This is a significant departure from the cost principle. So a company categorizes a security as a trading security, and they will record these at fair value. So every time the financial statements are issued, the trading securities must be adjusted to the current market price. Well, many of you follow the stock market, and the market is up, the market is down. Companies have to make a journal entry every time they publish financial statements to adjust the value of their trading securities. So, if a company categorizes a security as a trading security, that gain or loss, which can be recognized every month, one month you could have a gain, one month you could have a loss, these are called unrealized gains or losses, but they will affect net income. And they will be recorded, those gains or losses will be recorded on the income statement. However, if a company categorizes a security as available for sale, all that means is it's not going to be traded with great frequency, but the company does intend to sell those investments sometime in the future. They can be classified as current assets. They can be classified as long-term assets. It just depends on the intention of management. So the role of the accountant here is really to clarify what the intent is with these securities. And no, if a company keeps flip-flopping month to month, that doesn't really make sense, just to make their numbers look good. And an auditor would catch that in an annual audit or a quarterly audit. Available securities are also recorded at fair value. And changes are, but however, it does not affect net income. This is recorded as a separate entry in the stockholders' equity section. So let's say you have a security you categorize as available for sale, you adjust it to market, you make the journal entry, but that whole adjustment is housed within the balance sheet. It doesn't hit the income statement. Let's take an example. Let's go back to trading securities. Pace Company invests in two stocks. Both are classified as trading securities. And when you do this sort of analysis, you need to group your trading securities together and you need to group your available for sale securities together. So here we have Yorkville bonds, Kodak stock. It doesn't matter. They're both trading securities. This was our cost that we paid for it. This is a real cost that we paid, but now we're comparing it to current market price. And you can see that on the bonds we have an unrealized loss of $2,000. On the stock we have an unrealized gain for $2,000. We don't have to deal with the individual numbers, we just deal with the total number, which is a $7,000 gain. Okay, we have to do a journal entry. Market adjustment, trading, debit $7,000. Unrealized gain, income, credit $7,000. So let's talk about what in the world these accounts are. Market adjustment trading is an account that is a balance sheet account, and it's put on the balance sheet right below the trading securities, showing that this is the adjustment to market. This writes up the assets $7,000. The unrealized gain income, and that is the account title. Be sure to use these full account titles here. Unrealized gain income credit $7,000. That will be reported on the income statement. Now, what would happen if those securities were not categorized as trading securities, but they were categorized as available for sale securities? Why, then we would use different account titles, because we would not want to categorize them as trading securities, and the account title for available for sale securities would be unrealized gain or loss equity account, unrealized gain or loss income account. This first account is also a balance sheet account, and it would reside right next to the available for sale securities, either in current assets or long-term assets, depending on where the available for sale securities were categorized. However, the unrealized gain or loss income account, that is going to be in the stockholders' equity section of the balance sheet. It is not going to show up on the income statement. So let's take an example. Assume the Engrio Corporation has two securities categorized as available for sale. Campbell Soup bonds, Hershey Corporation stock. Campbell Soup bond appreciated, has an unrealized gain of $10,063. Hershey Corporation stock has an unrealized loss of $19,600. Net $95.37 loss. So in the trading securities, we had the market adjustment as a debit entry. In this transaction, the market adjustment is going to be credited because we're writing down the balance sheet. And it's a new account available for sale, market adjustment available for sale, but we're writing down those accounts. The debit is now going to be unrealized gain or loss equity, not trading, and it's a debit of $95.37. So when that unrealized gain or loss is a debit, we know it's a loss. So if it's a gain, it'll be a credit balance. If it's a loss, it'll be a debit balance. And if it's a gain or loss, then its balance will vary. So we saw, let's go back and look really quickly at the adjustment for the trading security. The textbook presents this as a separate account, unrealized gain income. If you'd had a loss, it would have been a debit, and it would be unrealized loss income. For the available for sale securities, they just use one account, unrealized gain or loss, and it's debited or credited depending on whether it's a loss or a gain. Okay, let's take a last practice one. Again, I'm not going to show you the solutions here. They'll be at the end of the last PowerPoint. So let's do a year-end adjustment. Jubilee Farms, as you remember, $200,000 had purchased $200,000 worth of Whole Food Market bonds. Let's do the adjustment. The cost was $200,000, but the fair value of these bonds are $192,000. These bonds are categorized as available for sale securities. So stop the presentation now, or go back a few slides and see how we accounted for available for sale securities. We have that market adjustment, equity, and gain or loss available for sale. And as you can see, we do have a loss of $8,000. This ends part 3. Please go on to part 4.